Right now, if you're an investor, you are staring down a wall of worries. We're talking trade tensions, fears about the credit market, even a potential government shutdown. So why in the world is one of Wall Street's top strategists making a forecast that seems to completely ignore all of that? Well, we're about to unpack a truly shocking call for the stock market.
Yep, there it is. 7,000. This is the number that has everyone buzzing. FundStrat's Tom Lee isn't just forecasting some, little end-of-year bump. Nope, he is calling for a massive surge in the S&P 500. And the obvious question is, how? How on earth does he get to that number? And just so we're all on the same page, this isn't some casual, off-the-cuff prediction. To call 7,000 the low end, wow, that is a statement of extreme conviction. It basically signals a belief that the underlying drivers in the market right now are so powerful they can just steamroll the widespread fear we're all seeing and feeling. So how does he justify such a wildly bullish call? Well, first things first, we have to look at what he's up against. Lee directly confronts what he calls the wall of worry, the very real fears that have investors completely on edge. Let's break them down.
Okay, so these are the four big ones. You've got this murkiness in the private credit markets, which always spooks investors because, well, you can't see the risk hiding in the shadows. Then you have the VIX, Wall Street's fear gauge, which has been jumping all over the place, signaling a ton of anxiety. And as if that's not enough, we're still dealing with ongoing trade tensions and the looming threat of a government shutdown. It's a real fog of uncertainty out there.
And this slide really gets to the core of his counterargument. On the left, that's the market's big fear, that we're on the brink of a widespread credit crisis. But on the right, you see Tom Lee's view, which is totally different. He doesn't see a systemic collapse. Instead, he sees what he calls an idiosyncratic issue. What that really means is he thinks it's just a temporary pause as nervous investors pull back their cash. It's not a sign that the whole system is broken. It's a problem in specific spots, not everywhere. Okay, so after tackling the fears head-on, here's where the case for 7,000 really starts to build. Lee points to four incredibly powerful tailwinds that he believes will not just fight back against all that negativity, but will actually launch the market much, much higher by the end of the year.
First up is a force that, let's be honest, we're all talking about: artificial intelligence. But the key word here isn't just demand, it's accelerating. The investment, the development, the whole cycle in AI isn't slowing down. Lee's argument is that it's actually picking up steam, which provides this huge fundamental engine for growth. Now, this next point is absolutely fascinating because it's all about professional pressure. Get this, a staggering 78% of institutional investors, the big money managers, are failing to beat their benchmarks this year. So what does that mean? It creates something called a performance chase. To keep their jobs, they might literally be forced to pile into the market to catch up, adding some serious fuel to any year-end rally. This is just a classic market concept. When pretty much everyone gets fearful and sentiment flips negative, which it has recently, it often means the worst has already been priced in. So for a contrarian investor like Tom Lee, this widespread pessimism isn't a reason to sell at all. It's a huge, flashing green light, a powerful signal to buy. And finally, it looks like history is on his side. I mean, look at this. The average rally in the fourth quarter going all the way back to 1950 is about 5%. But then look at Lee's forecast for this year, a much stronger 7 to 10% gain. A big part of that is because the Federal Reserve is in an easing cycle. So that historical tailwind is a really key piece of the puzzle for getting to that 7,000 target. Okay, so if the whole market is heading higher, where are the specific opportunities? This is where that contrarian view really shines, by focusing on those unloved, beaten-down corners of the market that fear has left behind. I just love this quote. It's such a great way to put it. Basically, that muscle memory from the banking stress we saw in 2023 has caused investors to just sell off regional banks and small-cap stocks without thinking. But Lee argues that today's issues are about underwriting, not that systemic rate shock from last year. And what that means is a lot of really good companies have been unfairly punished. And here is the hard data to back that claim up. I mean, check this out. S&P 500 earnings growth is looking pretty solid, right? Around 10%. But then look at the number for small caps, a mind-blowing 48% projected growth. That is a massive, massive disconnect between how the market feels about these stocks and what's actually happening with their bottom line.
Now, the analysis didn't just stop with stocks. It also dove into another area where sentiment has gotten pretty sour lately: crypto. After a huge pullback, what's the outlook there?
The really key insight here is that the recent crypto crash wasn't some crisis of faith in the technology. It was a technical event. As you can see, it started with broader market fears, which then triggered a huge wave of forced selling, the biggest in crypto history, actually, wiping out tons of leveraged positions. The result? A lot of investors are now just cautiously licking their wounds, with some even rotating into the perceived safety of gold. This wasn't about the long-term case for crypto. It was pure short-term market panic.
But, that whole deleveraging event actually has a silver lining. With so much of that risky, speculative leverage now wiped out, Lees uses this fantastic analogy. The crypto market is in the basement. The damage is done. And now it's beginning that slow process of working its way back up, but from a much more stable foundation.
So, in the end, we're left with this clear battle. On one side, you have a wall of worry built on very real fears. But on the other, you have this really bullish case built on AI, institutional dynamics, and historical trends. The question isn't just if Tom Lee is right. It's whether the market has been so focused on all the risks that it's completely missing the opportunity sitting right in front of all of us.